I wish to consider one sum on partnership retirement. Observe the sum on the screen. First I will read and explain to you. Then I shall solve the sum here before you. Let me start. I read the sum for you. X, Y and Z are partners of a continuing business sharing profit loss in the proportion of 2:2:1. The balance sheet of their firm as on 31st of March 2003 is as under. This is the balance sheet given to you. On asset side you are given the information of patents, land and building, machinery, bills receivable, motor car, stock, debtors, cash on hand and profit and loss account debit balance. The profit and loss account debit balance 10,000 is an undistributed loss. That loss gets distributed amongst partners in their profit sharing ratio 2:2:1 and this loss gets debited to partners capital account. Observe it. On liability side you are given the capital of X, Y, Z. General reserve is also 10,000, that is an undistributed profit. This undistributed profit 10,000 gets distributed amongst partners in their profit sharing ratio, that is 2:2:1 and that gets credited to partners capital account. 10% mortgage loan, provident fund, work and profit sharing fund, creditors. X has retired, so first partner has retired. The terms are as follows. Provide 10% depreciation on building and machinery. So 10% depreciation means decline in value. Decline in value is to be debited to revaluation account. Other name thereof is profit and loss adjustment account. Land and building 50,000, 10% decline, 5,000 debited to revaluation account, 45,000 rupees will appear in the balance sheet. Machinery also 50,000, 10% decline, 5,000. 5,000 will be debited to revaluation account, 50,000 minus 5,000, 45,000 will appear in the balance sheet. Value of stock is 44,000. Now stock is given to you 60,000. Book value is 60,000. Valuation made 44,000. Decline in value of stock is 16,000. That is debited to revaluation account and stock will appear at a value of 44,000. Goodwill of the patents are valueless. So patents, book value of patent is 10,000. Valueless means zero value. So 10,000 is the book value. Valueless means zero value. Decline in value of patent is 10,000. That decrease in value of asset is debited to revaluation account. And patent being valueless won't appear in the balance sheet. Goodwill of the firm is valued at 75,000, but the accounting treatment is to be given in the books without opening goodwill account. So goodwill adjustment is to be given to capital account. How to give the goodwill adjustment to capital account? Find the share of retiring partner in goodwill. That share will be paid to a retiring partner by a continuing partner in the ratio of gaining. The ratio in which they have gained the share in profit, in that proportion, goodwill will be paid by the continuing partner to the retiring partner. I shall explain the goodwill concept. First of all, let me first finish the sum. X would take the motor car at 20% less value. X is a retiring partner. Motor car value is 20,000. Decline is 20%. 20,000 into 20%, 4,000 decline. So X has taken the motor car at a value of 16,000. X has taken, X is the receiver, debit the receiver, X capital account debit 16,000, loss on transfer 4,000 debited to revaluation account, motor car account gets credited with 20,000. As motor car is transferred, it will not appear in the balance sheet after retirement. X is to be paid 47,400 immediately and the remaining amount is to be retained as 6% loan in the firm. So part payment is made and the remaining balance of capital account of X is transferred to his loan account. Now after explaining this concept, after reading the sum, let me first take up goodwill adjustment. Just observe. The goodwill of the firm is valued at 75,000, but the accounting treatment is to be given in the books without opening goodwill account, so it should be adjusted directly to capital account. For this, let me work out old profit sharing ratio, new ratio and gain ratio. Profit sharing ratio is 2:2:1. X retired. New ratio after retirement is not given. Gain ratio is separately not given, that we have observed in the sum. So what happens? Old ratio is equal to gain ratio is equal to 2:1. So 2:1 is the gain ratio. Now who has retired? X has retired. So 75,000 into 2 by 5 is the share of X in the increasing value of goodwill. So X gets 2/5 of 75,000 as his share of goodwill. That amount is 30,000. This 30,000 will be paid to X by whom? Y and Z. In which ratio? In the gain ratio. So this 30,000 is required to be distributed in the ratio of 2:1. Observe it. This is a gain ratio. So 30,000 into 2 by 3, 20,000. X receives from Y. 30,000 into 1/3, 10,000. X receives from Z. Journal entry for that. The partners who pays, their capital account is debited. The partner who gets, their capital account, his capital account is to be credited. So the journal entry for adjustment to capital account, Y's capital account debit 20,000, Z's capital account debit 10,000, to X capital account credit 30,000. Here the goodwill adjustment is recorded without opening goodwill account. It is adjusted directly to the capital account. So the partner, retiring partner, gets his share in goodwill from continuing partners in the ratio of gain. And observe, this is the journal entry for adjustment entry for goodwill. This I will take care of while solving the sum. Now let me start with the sum. Here I prepare revaluation account, cash account, partner's capital account, balance sheet after retirement. First I will start with revaluation adjustments. Provide 10% depreciation on building and machinery. So land and building 50,000. 10% depreciation there on 5,000. So 45,000 is the value that will appear in the balance sheet. And decline 5,000 debited to revaluation account. So journal entry for that is revaluation account debit 5,000 to building account credit. How much? 5,000. Now same way, machinery book value is 50,000. 10% depreciation there on 5,000. Value of machinery after decline 45,000. That appears in the balance sheet. And 5,000 is debited to revaluation account. Journal entry for that is revaluation account debit to machinery account credit. Here I have written the word depreciation on machinery. That also you can write. If you write the entry revaluation account debit 5,000 to depreciation provision on machinery account credit 5,000, then that depreciation provision gets deducted from 50,000 on the face of balance sheet, and the net value that will appear in the balance sheet will be 45,000. Observe it. Now value of stock is 44,000 and patents are valueless. The book value of stock is 60,000, valuation made 44,000. Valuation made 44,000, decline is 16,000. 44,000 will appear in the balance sheet and 16,000 is debited to revaluation account. So what's the entry? Revaluation account debit to stock account credit. Next, patents are valueless. Book value of patent is 10,000. Valueless means valued at 0, nil. Decline in value of patent 10,000. This decrease is debited to revaluation account. Journal entry revaluation account debit to patents account credit. As the patents are valueless, it won't appear in the balance sheet. So only one effect. Revaluation account debit, patents account credited, patent account gets closed, it won't appear in the balance sheet. Now, X takes the motor car at 20% less value. Motor car is 20,000, 20% less thereon, so 4,000 decline. 20,000 minus 4,000, 16,000. X takes it. X is the receiver, debit the receiver, X capital account debit. Loss on transfer 4,000 debited to revaluation account. Motor car is transferred, so now Partnership firm is not the owner of the car, it is transferred, so motor car won't appear in the balance sheet. Observe it. X capital account debit, revaluation account debit, 2 motor car account credit. X capital account debit 16,000, revaluation account debit 4,000, to motor car account credit 20,000, motor car won't appear in the balance sheet. Next. After considering all this adjustment, let me copy the remaining balance sheet. So remaining balance sheet details you find with black color. So capital of X, Y and Z balance brought forward. General reserve 10,000 distributed in the ratio of 2:2:1. So 4,000, 4,000, 2,000. Journal entry for that is general reserve account debit to X capital account credit 4,000, to Y's capital account credit 4,000, to Z's capital account credit 2,000. Provident fund 10% mortgage loan 20,000. Provident fund 20,000. Workman profit sharing fund 10,000. And creditors 40,000 will appear in the new balance sheet at its original old value because they are not subject to change at the time of retirement. Next, bills receivable 10,000 asset side, debtors 40,000 asset side, cash on hand 50,000 balance brought forward. Now this profit and loss account debit balance 10,000 debited to partners capital account in their profit sharing ratio, that is 2:2:1. So 4,000, 4,000, 2,000. Observe it. X capital account debit 4,000, Y's capital account debit 4,000, Z's capital account debit 2,000, 2. Profit and loss account credit 10,000. This is the journal entry. So all the details of balance sheet are taken care of. Now I want to close revaluation account. There is a loss. Total is how much? 40,000. So total of debit side is 40,000. 40,000 is the loss because there is nothing on the credit side. That will be transferred to partners capital account, debited to partners capital account in their profit sharing ratio, that is 2:2:1. 40,000 into 2/5 share of X, 40,000 into 2/5 share of Y, 40,000 into 1/5 share of Z. 16,000, 16,000, 8,000. X capital account debit 16,000. Y's capital account debit 16,000. Z's capital account debit 8,000. To revaluation account credit 40,000. Revaluation loss is distributed. I have already explained to you goodwill adjustment. Consider the goodwill adjustment. This is the journal entry that we recorded for goodwill. Y's capital account debit, Z's capital account debit to X capital account credit. Let me complete its posting. Y's capital account debit to Y's capital account debit 20,000, Z's capital account debit 10,000, to X capital account credit 30,000. So 20 plus 10, 30,000 is credited to X capital account. This is how goodwill adjustment is explained and posted here before you. Next is capital adjustment. X is to be paid 47,400. X is paid. X is the receiver. Debit the receiver. X capital account debit to cash account. 47,400. X capital account debit to cash account credit. And the remaining is to be retained as 6% loan. So let me close X capital account. Total of credits at 80,000 plus 20,000, 1 lakh plus 10,000 plus 4,000, 1 lakh 14,000. From that you are required to deduct items debited, that is 4,000, 16,000, 16,000 and 47,400. The remaining amount is a loan amount, and that amount works out to be 30,600. X loan 30,600 will appear on the balance sheet liability side. Now let me close cash account. 50,000 minus 47,400 payment. Cash balance 2,600 will appear in the balance sheet asset side. 2,600 cash balance sheet asset side. Now I want to close the capital account of Y and Z. Balance will be transferred to balance sheet for reporting. So 84,000 minus 40,000. 44,000 is the balance of Y. 42,000 minus 20,000. 22,000 is the balance of Z. That is reported in the balance sheet. These are the balances that I have worked out. That is reported in the balance sheet. So now my balance sheet total should agree. Let us have a total of asset side and liability side. Total should be same. Here total of liability side is 1,86,600. You can make the total, no problem. And the total of asset side is also 1,86,600. 1,86,600 is the total of balance sheet. This is how the sum is solved here before you. I think you must have followed this sum. Thanks to all of you.